There's always just a little extra juice when we do these in person, isn't it?
I couldn't agree more. We're here in Miami.
Yeah. Well, last time we were in Miami, it was together, I should say. It was for Hunter Thompson's Race Fest event, or no, Raise Masters Retreat. In any case, this is my second time in Miami. Never a bad place to do a business trip, huh?
I know, right? Pretty nice in November.
Every time I come here, I get it's a friendly reminder that it's an ESL place. And I was listening to a Joe Rogan podcast, and he's like, "Yeah, it seems like Miami's a place where you need a passport to get to," which feels very much so true after being here. A lot of Latinx people,
A lot of palm trees.
a lot of palm trees, very tropical. It's beautiful. Got to play Doral. Trump National has got a incredible complex there. 4 golf courses. Got to play one of them today. It's very good, but excited to be here. It's always a treat.
Absolutely. Let's crack into it.
Not every real estate conference location is the best, but it's really nice to come to Florida, particularly this time of year. With that said, we do have a very full agenda. Happy election week. Make sure you go out and vote and support whatever candidate that you may that you want to lead the country. Hopefully, you like at least one of them or are excited about the direction. But we're hoping to get a conclusion of that this week, and hopefully it's not drawn out, so we get certainty moving forward. But speaking of election, treasuries, there's definitely a bit of correlation there. Some people have been speaking to have mentioned that they find Trump to also be a pretty big spender when he was in office, but also just generally speaking. And Trump being a spender is kind of pushing treasury rates a little bit higher, some have said. But I'm curious to hear your take on this because, as we know, about a month ago, was it, that we actually got our first rate cut? But as we stand today, the treasury market, which is what our debt is usually predicated off of, correct me if I'm wrong here, has shot up higher today than what it was when the rate cut happened. So I'd love for you to have your takes on that.
Yeah, sure. A lot to unpack there. There's always that classic confusion that people have between short rates and long rates. And so some people, number one, don't know that there's a difference that exists there. And then number two, they're not sure which one is the tail and which one is the dog. And so first let me break down short and long treasuries. So on the short end of the curve, you have treasury, you have SOFR, or the Fed funds rate. And obviously the Fed directly controls the Fed funds rate. So when the Fed cuts rates, that's going to bring down the Fed funds rate, and it's also going to bring down SOFR. And so if you have a short-term loan or a floating rate loan, that's going to be priced based off of SOFR, and that's going to adjust every single month. And that's why it's a floating rate loan, because it readjusts every month. Now, when you talk about borrowing long-term, such as you are buying a house with a mortgage, or if you're buying commercial real estate with a 5-year, 7-year, 10-year loan at a fixed rate term, that's going to be priced based on treasuries, and we call those long rates because 5-year loan, 7-year loan, 10-year loan, those are long rates, and then SOFR, or a short-term loan, those are short rates that adjust on a month-to-month basis. So those are the differences, and so they don't move in lockstep, which is something that people don't always appreciate because they think, oh, the Fed cut rates, well, doesn't that mean my mortgage comes down, right? And they might experience that in their economic reality, but it's not an economic truth because in the reality, the Fed controls the Fed funds rate and then short rates, but they do not control the long end of the curve, at least not with monetary policy. They can control it with fiscal policy or other means such as actually direct bond market manipulation like quantitative easing or buying bonds, right? Obviously, if the Fed is going to buy the government's debt, it's going to artificially compress yields because they're artificially propping up demand. So that's all the complicated stuff that's going on behind the scenes. But at a very basic level, just because the Fed cuts rates doesn't actually mean that the long end of the curve, which is what you and I want to see come down, is going to go down. And actually, historically speaking, there's precedence for a rate cut to actually cause rates to go up, at least in the short term, because it can provide relief to the market and the market can kind of go, and have an exhale. And then that will actually make the long end of the curve go up because the 10-year US Treasury yield, for example, is a flight to safety asset. So when there's a recession, when people feel uncertain, they pile in to treasuries and then that drives the bond rate, the yield, to go down. However, when a rate cut happens, that might provide some relief to the market and they might go, okay, you know what? The Fed might be getting this right. We might not be going into a recession, and therefore they take a risk on approach. So they actually sell treasuries and buy stocks. So we've seen a great rally in stocks. I mean, really, stock equities have been an amazing place to be over the last
Stock market's
18
been
months.
so hot.
Yeah. So, but what we didn't expect is just how high and how aggressive the rates, long end of the curve that is, go up. And over the last, 6 weeks max, we've seen long end of the curve, 5-year, 7-year, 10-year Treasury yields go up 75 basis points. Now, that might not sound like a lot because it's just, oh, well, it's 0.75%. But in our world, 75 basis points is a complete reality changer. So
That basically makes a deal, really, if you're under LOI, you have a PSA, which basically means you are in contract to acquire the opportunity. If that in fact happens, it goes up 50 basis points, 75 basis points. It gives me shades of a deal that we were looking to acquire in Dallas, but unfortunately, with the deal materially changing like that, with the numbers kind of being thin and kind of a changing and turbulent market, we didn't feel comfortable with investors' dollars in it. We are going through a raise right now, and we're not comfortable with where it's at. We are confident that between now and closing, which is you really rate lock, the week before closing, the week of closing, that it will kind of come back down. But for this moment right now, it's definitely a little bit unsettling. But if you had to guess right now, and I just pulled it up, did double sourcing here, what do you think the 10-year Treasury is at today? Maybe you peeked and cheat, and I know you have it on your phone, but do you know what it is right now?
well, it's a Sunday, so the market's not open. But the 10-year, I follow the 5-year very closely. As you know, it's on my phone, so it's on my screensaver. But I would guess that the 10-year right now is, probably 435.
Yeah, 4384, which is just brutal. So it's going up in real time as we speak. And just for those who want to have an understanding of what's going on there, these deals aren't just to the point where you've got 150 basis points, 300 basis points of positive leverage, meaning your capitalization rate, your cap rate is exceeding your interest rate by X amount of basis points there. These deals are usually pretty close or maybe negative levered in most experiences. We've been able to, fortunately, buy tax exemption deals which provide a higher cap rate than par, which we're getting into later in the show. But for the run up to go up 75 basis points is very challenging. And one of the reasons why it's challenging, not on just the deal that we're in right now, but for every opportunity we put an LOI out for, it basically means that that offer is null and void and no good because we wouldn't feel comfortable transacting on that opportunity with the debt currently today. So the problem is not where the rates are necessarily. I think we'd like them to be low, but it's all good. But the issue is that pricing comes down slower than how quickly the volatility up or down the treasury market and interest rate market is, unfortunately, which is why there's been really, amongst many other reasons, but I think particularly of late, why transaction volume has really gone down. I think that coupled with the election has made really every deal or every seller just say, hey, I'm going to punt this one. Hey, I'll do an off-market opportunity for maybe a sucker that would pay the price. Whatever it may be, this is just really causing transaction volume to be halted, which is a really big bummer for someone like us, for groups like us. It's also a problem if you're looking to get out of a property. I think that other thing I had come to mind as well, I've been thinking about this a lot recently, is I personally believe, and this is an opinion, not a fact, but I actually think that debt is not going to go as low as people hope it will go, and debt will in fact be higher for longer. And I'm not the only one saying that. That's been said, I think many, many times through our hopefully future friends at the All In podcast. They're talking about debt being higher for longer. I think where Treasury is pricing in right now, it'll be higher for longer. Some of the economic information, though, and data, it's like, are we in a recession? Are we not in a recession? I have my opinion, but I don't know if my opinion is just personal and not factual. But the stock market's up, GDP numbers were okay, but then the job report just came in. That's going to get marked down. So I know I give you a lot to chew on, but can you kind of extract a couple thoughts there?
Yeah, a lot to chew on. You hit the nail on the head as far as transaction volume. We're heading towards the end of the year. It's already the start of November, and with that, like you said, election is right here. We've seen a tremendous climb in rates, which creates a lot of uncertainty and repricing. So this is so long story short, a lot of sellers that have been wanting to go to the market or even hit the market are pulling their deals, and the broker saying, you know what, let's shelve this opportunity. Let's remarket next year when there's more stable ground. We know the election results and hopefully rates come down, right? So there's just not a lot of activity going on right now because the way that pricing works, and it's so interesting to see all this happen in real time, is as we put out offers, we're pricing the deal based on where treasuries are at that point in time. So it's live feedback. So like you said, I'm looking at my phone every day to see where treasuries are because that's going to actually immediately impact the price we're willing to pay for an asset. So if we put an offer out and then 2 weeks later the seller picks up the phone and says, "Oh, thanks for the offer." Yeah. Well, if treasuries moved up 25 bips in that period of time, we might not be inclined to actually honor that original offer. So you talk
Which
about
is known as a retrade for those who do or don't know. If you're in contract on something, you basically need the purchase price to effectively go down so you come to at least a relatively close equivalent to where the pricing and the debt would be reflected upon the increase of rates. Because the rates are higher, the property valuation will in fact be compressed and go down.
Yeah. Well, I don't want to get too off topic, but in terms of retrading, I think there's a bit more of a nuanced definition there because when people hear the word retrading, especially if they're in our business, I would say perhaps a little bit newer in our business, they think that's a really
Cardinal sin,
super negative thing. And obviously brokers don't want to hear me say this, but the reality is retrading is actually somewhat normal, and I wouldn't call an adjustment to the price a retrade unless it's unwarranted or based on something that was already known. So for example, if I want to buy a property from you and I do my inspections and I know that you have a bad roof, but I go under contract with you anyway. And then 30 days later, the due diligence period is about to end. I've already tied you up for 30, 60 days. And then right as my money goes hard, I come back and say, you know what? I need $1 million off the price because your roofs are bad. Everyone's going to be pissed because that was a knowable risk that I should have factored into my original offer, right? And not something I leveraged. Now, however, if I go under contract with the intention of purchasing the property with fixed rate debt, and then the rate goes up by 75 basis points, that was something I couldn't have factored in up front. And I think it's something very reasonable to be honest with the brokers and the sellers and just let them know, hey, I can only withstand a 20 basis point move in rates. That's how I've priced the deal. And you know what's a red flag is if I go to the seller and say, you know what, pick me as the buyer, don't worry about it. I can withstand a 75 basis point increase in rates. Guess what? That implies to the seller two things. Either you're a liar, or two, you have way too much juice in your numbers and you're not actually offering your highest price that you can afford. And so both of those things are no good. So it's just better to be honest. And if you present a price adjustment or a retrade down the road based on legitimate issues that come up along the way, I think you can do that and preserve your reputation in the market.
That's, it's going back to this, controllable and not controllable. You can control having good due diligence. You cannot control the treasury market going wild in the wrong direction. On the contrary, it's really fun when treasuries are going down and you maybe underwrote 6% and you game at 5.5, kind of like what we did on Cortland Med Center, now known as Lakes at 610. But you live by the sword, you die by the sword. It's just a very frustrating time though for everyone involved. It's volatility that kills transactions. It's not high debt or high prices. It's just the unfun and unfortunate sake of the circumstance on the movement, which is not going in the right direction, which causes the problems. So any other treasury thoughts you want to unpack here? One final, actually, let me say that back. I'm gonna steal your answer here, or steal an answer. One interesting thing about what we do in the marketplace can differ from maybe a lot of people who've got money in the stock market, stockbrokers. They might check the S&P 500, the Dow Jones, the NASDAQ, maybe whatever stock that they have. If they've got Tesla stock, Apple stock, so on and so forth, they check that religiously. If you're in the real estate world, you're checking the treasury market religiously. It's funny. The first thing I probably do every single day when I wake up is I check Pensford letter to see what's going on pertaining to the treasury market, the debt market. I don't know if you can relate to that, but it's just the nuances. If you're an investor in the investment space, kind of like us, if you're a stockbroker, so on and so forth, you just check different indicators.
Yeah. So the funny thing is if you want a solution to that problem, then you could just become a floating rate borrower, because it's actually it's a little bit counterintuitive, but the reality is if you're a floating rate borrower, then your rates are more stable on a day-to-day basis, which is funny to say because obviously the whole thing about floating rate debt is the volatility associated with your rate floating. So it's counterintuitive, but the funny thing about that is if you're a floating rate borrower, your rate, while will fluctuate through your hold period, is pretty much set and knowable from the time you go under contract. The problem with fixed rate debt is you go under contract assuming you're going to be able to get a fixed rate loan of 6%, and then rates run up on you, and now you're looking at locking in a 10-year loan at 6.5%. So while under contract, from the time that you want the deal to the time you lock the rate, a lot could happen, and that consequence is a 5-year, 7-year, 10-year consequence, because you're talking about locking in the rate for that period of time. Whereas if you're floating, and let's say floating rates are high right now, but the Fed is cutting, and you mentioned your own opinion about the Fed perhaps not cutting as deep as maybe originally people thought, or whatever, all that stuff. But there is consensus that the Fed will cut rates. So if you are a floating rate borrower, you could close on a deal today knowing positively or happily that your rate's going to come down over your hold period. Whereas if you get caught in a bad timing where you have to fix and close on a fixed rate loan when the rates kind of just popped up high, 20 bips too high, you're stuck with that high loan for the next 5, 10 years. So we as sponsors, I would argue, bear the biggest brunt of that floating rate risk. And I should be careful with my words, because I don't mean floating rate risk. I mean Treasury volatility in anticipation of locking our interest rate. Because like you said, and we've talked about this story before, and it hurts to bring up, but last year we put a deal under contract in Dallas, and then rates went up 75 basis points, and we didn't have cushion in our numbers, and we didn't feel comfortable going to our investors and saying, hey, this deal now is going to project 12% return, or whatever it looked like, right? And we couldn't get a price reduction from the seller. We had no choice but to terminate the deal. The sellers confiscated our earnest money. We lost out on all that time and money, and we refunded our investors. So we gave investors their money back. They didn't lose any money, but obviously they lost out on investing in what would have been a good deal. And for us, it was a really bad swing, because it went from buying a property, collecting acquisition fees,
Being excited about growing a portfolio in Dallas,
adding a new property to the portfolio, growing the business, and instead we lost all that and we lost money. So it's really nasty to be taking these risks as a sponsor, but as a fiduciary to our investors, we have no other choice but to take these risks, and it's what we get paid for. So that's one interesting dynamic. The other interesting dynamic as far as Treasury volatility that I want to share before we move on is the idea, I was getting to this earlier, then I got distracted by your Retrade comment. Every day we put out offers, and we put offers out based on where Treasuries are at that time. And we usually bake in maybe a 10 or 15 basis point cushion there, right? We want to have a buffer just because of the daily fluctuations of rates. It's very abnormal for rates to move 25, 50, 75 basis points in the span of a month. It's ridiculous. It makes it very difficult to transact. So we have to adjust our pricing on a day-to-day basis given Treasury volatility. And so we're not alone in that. We're a buyer just like any other buyer who's doing the same thing. So it's just interesting the way that buyers react immediately to Treasury volatility or moves in Treasuries. However, on the sell side, as a seller, you're not going to be as willing to move your sales price based on the daily fluctuations of Treasuries, right? You're not going to say, my property's worth $50 million, and then Treasuries go up the next day and say, my property's worth $49,750,000, right? A seller in their head thinks, my deal's worth $50 million.
The number is the number.
The number's the number, and that's what I'm selling for. And that's what makes kind of the disconnect between buyers and sellers occur, because buyers are adjusting on a daily basis, and then sellers are much slower to react. So in an environment where Treasuries are rising, there's a lag effect where buyers can't make sense of deals because they're reacting to the data immediately. Sellers are looking in the rearview mirror and are being stubborn, and that creates a bid-ask spread. Now, like you alluded to, we've actually been really blessed this year to have caught Treasuries on the downswing every single deal we've locked rates on this year. It's a big blessing, and what that means is, same way, sellers aren't going to say, oh, Treasuries went down today, well, my deal's now worth $50,250,000, right? The number's the number, and they're kind of stubborn in the different direction as well, right? So we actually, like you said, can come out ahead, where if we priced based on a 6% rate and then Treasuries are on a decline before we lock, we actually can capture that savings, and that can be a big boost to our cash flow over our hold period. So ideally you want to time it that way, but like you said, live by the sword, die by the sword.
Well, ideally, you don't have to time anything crazy too. Ideally, you don't have to worry about it. Ideally, it's just mellow, because if you're in this business long enough, we hope to be selling as much as we're buying. Maybe, the ratio would be for every property we sell, we're buying 1.5 properties effectively, so we're still nicely growing. But that will affect us on the exit as well in some of these deals at some point. So no one wants that to happen, just to be clear. It's not a fun situation. I think we'd rather have more creative debt than not, but it's just very frustrating. It's something that we as sponsors have to work through, educate our investors on. One of the most frequent questions I get is, hey, have we rate locked yet? When it's, months in advance, like midway through the process, because maybe they heard or saw an article about, debt being good someday, or maybe there's a, downward movement in Treasury, something of that nature. There's some misnomers there. Can you just talk about how the rate locking process works just once more? I don't know if we have in the future or in the past before, but would really love for you to just maybe debunk some of the maybe potential myths there and how that kind of all structures.
Yeah, so generally speaking, when you talk about specifically agency debt, which is what we primarily borrow, but I would say most commercial debt is this way. You get quoted a rate, but that quote is not an all-in rate. So the lender isn't saying, all right, I'm quoting you a 6% rate. What the lender is saying is, I'm quoting you to make the number simple, a 150 basis point spread above the 5-year Treasury, 5-year US Treasury yield, right? So that's their quote. They're not promising you an all-in rate of 6%. They're saying Treasuries today are 4.5%, and we're quoting you a 150 basis point spread on top of that, which just so happens to be a 6% rate. So if Treasuries go down to 4, you get 4 plus 1.5 equals 5.5. And that's how you can have the fluctuations between the time you get quoted and the time you lock. And like you mentioned earlier, it takes quite a while to lock an interest rate because there's a ton that goes into it. You have to get the legal all ironed out with the lender. You have to have the due diligence all ironed out. So the lender is going to order third-party reports. They're going to order an appraisal, an environmental, and a property condition assessment. And they can't lock the rate before all those things happen. And also, until your org chart is baked, until they approve of the major investors, the loan guarantors, they have to look at my bank statements, they have to check my credit, they have to do all these things. And then once all that is approved, the loan is fully approved, then we can get the go-ahead to lock the rate. The reason why you have to go through all that and basically be ready to close in order to lock the rate is because locking the rate is not free. Because what you're doing is, because the lender doesn't want to take risk. The lender doesn't want to lock the rate and then rates go change on them, right? They don't want to take treasury risk just as we don't want to take treasury risk. And so what happens actually is there's actually bonds that are traded in the market in order to lock that rate. And so that way they're hedging out their risk. They're no longer taking that treasury risk anymore. So it's actually kind of a fun process where you get on the phone with the lender and the lender says, all right, we're in the market. They've got their JP Morgan crumply sounded like landline phone, and they're saying, okay, we're going to trade the bonds. We're good at 417 lock. Okay, good. We're done, right? And it costs, well, I can't say it costs, but when I said locking the rate's not free, there's a huge risk associated with locking your interest rate. We have to put up a 2% good faith deposit prior to rate locking. The lender's just not going to rate lock for free because they're going to incur all these transaction costs with the bond trade. So if you're doing a $40 million loan, or if we're doing a $40 million loan, we have to send the lender $800,000 in order to go ahead and lock that rate for us. And if let's say force majeure, something crazy happens, we don't want to buy the deal anymore, we don't want to close on that loan anymore, that $800,000 is gone.
And you're out your other dollars invested in the deal.
You're out another $1 million in pursuit costs.
Yeah. And I think one thing to really think about too, this is the beauty of syndication or working with a group like us, that I think some people ask me a lot, and I just want to reiterate this concept too. You take no upfront risk if you commit and wire your dollars in their deal. So essentially, let's say if the world goes to, a crazy spot, the debt market goes wild, we don't get the exemption on, property tax exemption on our deal. You don't take any risk. You don't bear any downside on that. Those are just dollars that we eat as a sponsor. We, of course, are going to make a very healthy amount of dollars when the property sells and we do well, but we also bear 100% of the downside should we not pull through with something and we lose, transaction cost dollars there.
Yeah. Yeah, I think it's a very valuable point to drive home for investors because
particularly this time.
Especially in a volatile time like this. And also volatility is where opportunity is. So there's still, as much as we're kind of bemoaning the challenges in the market today, I think both of us
Yeah.
are still very excited about all the opportunities.
This is the best time to buy. The best times to buy is when most people can't, right? I truly think that. Now, maybe we're the sucker that's buying, but I think dollar cost averaging is a smart play. But another thing to kind of bring it round trip here is very few groups are truly in the market right now because they've got legacy issues or they don't really have a way to make the numbers really make sense to work
They
out.
capitalize the deal.
They can't capitalize on it, or they've got to raise 60%, call it.
Again, they can't capitalize.
Yeah, exactly.
They don't
have
have
to
the
raise
investors.
so much equity down, like they just can't make it make sense where the numbers make sense. So there's really a big pruning process that's happening in the marketplace, and we're very fortunate to have kind of I'm not gonna say a cheat code, but a deal sizing up cheat code in the sense with some of our tax exemption opportunities. So let's transition into that. Actually, very seamless transition right there. PFC to HFC, you notice, are a game changer. Basically, are tax exemption deals for a lot of our investors. And if you're a capital allocator or an investor looking to invest in really cool, affordable options, but also a way to make deals pencil and make sense in this marketplace that are kind of market resistant to a certain extent because we're getting value add returns essentially at closing, email me. You know the email, but once more, it's craig@lscre.com. Very easy to find. But let's talk about the tax exemption game changer from a financing perspective.
Yeah. So on the show before, we've talked about our unique affordable housing strategies, partnerships with nonprofits, partnerships with housing authorities, and how this creates unique value by offering affordability rather than trying to do value add strategies where we have to renovate and raise rents in order to essentially end up at the same place in terms of return. Because not all returns are created equally, right? If I can get to a certain return threshold while taking less risk, that's a superior strategy. And so that's what we have. And I definitely encourage people who are listening that are interested in investing or partnering with us as a fund manager, please reach out to Craig.
Yeah, set up a call. I'll treat it like a demo because it's very simple. I'll just basically show you the property taxes where they are at, from trailing 12 to closing, and then show you what that kind of looks like on the summary section, and kind of how the NOI increases. But you were saying?
Yeah, so we've talked about this strategy and I think how beneficial it is, but something that we have perhaps overlooked a little bit is the advantages that it accords via the enhanced financing. And so since we're talking about debt and we're talking about locking the rate and all this stuff, I think it's a great transition to talk about the debt enhancements that we get through this. So because we're able to close on the property day one with a property tax exemption in place, that provides an immediate bump in NOI. And not only is that great for our investors, our cash flow and the value of the property, it's also great for the way that the lender sizes the loan for the property, because lenders look at NOI in order to determine how much debt they can offer the property and basically the risk level of the debt. Because if the property has more NOI, then the property can more easily service the loan. And that makes the lender feel good. Oh, and then you throw on top of that because we're doing a mission-driven, affordable housing strategy, that's in line with the agency's mission to further affordable housing. So they give us price breaks and enhanced terms as well. So through better terms such as more interest only, lower interest rates, and higher leverage, because of how well the property sizes from a debt service coverage ratio perspective, right? That's just simply the ratio between how much income the property has and the cost to service the debt, right? When you have those things put together, you get superior debt. So not only is the deal superior on an unlevered basis, it's also that much more superior on a levered basis.
So let's talk about some of the LTCs that we've been able to get on these deals recently. And a lot of the questions I get as well from investors, and I'm kind of happy we're talking your book here, is, hey, how can you guys in this marketplace, debt bad, debt very bad, don't do debt, less debt, de-risk it, so on and so forth. That is such a common question I get right now, which is fair because probably the deals that are getting crushed the most were deals that were probably in riskier bridge debt, deals with a riskier business profile, but people just think automatically right now, hey, that's not a smart idea. But we're here to say that the value lies in the nuances.
Yeah, for sure. And I think that's a really important point to drive home because, like I said, returns aren't all created equally. Well, LTVs aren't all created equally as well because we all kind of gravitate towards LTV. And for those that don't know, it's loan to value. we gravitate to that as our first metric of risk, right? We say, oh, well, what's the LTV, right? And so if you have a $100 million deal and you're financing it with $80 million of debt, it's very simple. That's 80% LTV. And people would consider that to be high leverage. Which it is. It is, yeah. And it's riskier than doing, let's say, the same exact deal, but at 60% LTV.
And as a matter of fact, sorry to cut you off here real quick, many institutional investors, call it the Starwoods, which we're right across the street from, the Pearlmarks of the world, the PPRs, so on and so forth, probably have a mandate right now from their IC, their investor committee, that they can't probably do a deal with less than 70% LTC, I would imagine.
No, they won't do more than 70.
So that's what I meant, yeah. So it would have to be 70 or less.
Yeah, generally speaking, the more institutional funds have a cap on either fund level LTV or deal specific LTV, right? The fund level LTV is a little bit friendlier because they can maybe take a little more leverage on some deals, take a little leverage on other deals, and balance out to their 70% constraint or something like that. But I want to drive this point home because I think a lot of people can miss this. So when you talk about the same deal, right, deal X, and if you talk about 80% LTV on deal X versus 60% LTV on deal X, yes, 60% is less risky than 80%. However, when you're comparing deal X versus deal Y and different LTVs, now things get more confusing because now you're talking about different deals. And so what we're able to achieve through our enhanced NOI at closing is a higher cap rate, a higher NOI. And so even if we're financing with, let's say, 80% LTV, which is high leverage, that's coupled with let's say, a 1.25 or greater DSCR. And a 1.25 DSCR simply means the NOI is 125% of the amortizing debt service payment. So I said a lot there. I know it can be complex. I'm not going to explain it all.
DSCR, basically, just for those who don't know, I think this is a very important note. This is what people seek for, is for every dollar of debt coming in, you've got $1.25 of cash flow coming in to cover that cushion. In the event that your expense ratio gets messed up, rents go down, so on and so forth, the lenders require that. That's what DSCR is. But with these tax exemption deals, we can buy at 80% LTC or even maybe greater in some instances if debt's really crazy. We get a good purchase price with still hitting the DSCR, debt coverage servicing ratio, of 1.26 to 1.25, typically speaking. That is why we can take out further leverage, because these deals size up so well. And that's why these tax exemption strategies are a game changer in many respects. So to be able to hit that with that leverage point is really how you exaggerate the returns.
Yeah, and I don't want to minimize LTV because it is an important metric, but I would argue that DSCR is more important and a more valuable risk gauge.
But many people, I should say, really only see the leverage point and get uncomfortable. They think it's the boogeyman, which is totally fine. We understand that, but what we're really solving for is to hit the debt coverage servicing ratio of that 1.25x plus number for agency finance deals. Now that there's very deep value add opportunities that might not size up there, but you're going to push that drive up, right? Or the yield up.
Yeah, so I don't want to get too far afield and overcomplicate things with other finance or other loan products which have other criteria, because if you're talking about a bridge loan, there's not a DSCR requirement, or at least not an in-place DSCR. So I don't want to go there now or on this episode, but I just want to really drive the point because it's counterintuitive. It doesn't make a lot of sense, but if you have deal X, this is very interesting. If you have deal X at 50% LTV with a 1.25 DSCR, okay, which exists, right?
That is the kind of the market right now. Actually, that is the market.
If you're buying in a high growth market, which i.e. means a low cap rate market, you're going to be
sub 6% cap rate. Yeah.
Well, yeah, you're going to be looking at buying a low 4 cap, and today you're going to be financing in the high 5s. So that negative leverage is going to mean that there's a lot of debt service relative to income, and so you're going to have to do 50% LTV just to scrape by at a 1.25. So let me paint the picture. Deal X has 50% LTV, 1.25 DSCR. Deal Y has 80% LTV and a 1.35 DSCR. So there's not necessarily a right or wrong answer, but let me just ask you, which deal do you think is more risky?
Well, can you say it one more time, please?
50% LTV, 125 cover versus 80% LTV, 135 cover.
Well, the riskier deal would be the one with the lower DSCR, of course.
So you think the 50% LTV?
Yeah.
Yeah, and I probably would agree with you. And I would say probably most people, if they really broke it down, would agree as well. The challenge is, like you said, people are going to be fixated on, well, 50% leverage, the property's worth 10 million and I'm only putting 5 million of debt on it. That's super low risk, right? But you have to look at the cash flow situation at the property. And so here's the thing. What does LTV protect you against? LTV protects against fluctuations in value. What does DSCR protect against? DSCR protects against fluctuations in cash flow or in NOI, right? And I would argue that fluctuations, what you want to protect yourself against fluctuations in income much more than you want to protect yourself against fluctuations in value, because you can ride out periods of declining value, because if you're not a seller, you don't care what the value of your property is, right? But the worst thing in the world that could ever happen is a drop in income that would then force and dictate a sale, because that means you're going to actually lock in that loss and you're going to lose money. But if you bought a property for 100 million and then it fluctuated, let's say market crashed and the property's value dipped to 80 and you financed at 80% LTV, your investment your equity investment went from par to zero, right? So on paper, you've lost your entire investment. But if you hang on and you don't sell, which, I mean, this happened, right? From 2022 to 2020 to today, well, it means already values have gone up a bit, but plenty of properties have lost 20% of their value. So a lot of people have lost their entire investment. But until they're a seller, that's just on paper, so it doesn't really matter. But it would matter if you don't have a positive DSCR and you don't have a way to service your debt and stay afloat. If the lender forces you to sell, or you don't have the cash flow to stay alive and you're forced to sell, then it's going to make you become a loser. So I would say that you do...
Big loser.
Big loser. DSCR is more important than LTV, but you can't take this argument to its extreme, right? Because let's not go crazy here and ignore the fact that lower LTV is better, right? Like, again, all else being equal, like now if I bring back to my example and I say both deals have a 130 cover, then of course you're going to say the one that lower LTV is lower risk.
Yeah, but it's funny because the leverage points, if the deals both perform the same, naturally the lower the deal with less LTV is going to dramatically smoke the other deal out of the waters, because dollars put in for X put out is going to be dramatic.
The higher LTV
Correct.
is going to smoke it.
Correct. Yeah, that's what I meant. What's actually really interesting, and this thought escaped me and it just came back to me about the Treasury note, everything going on there. One of the problems that actually happens when treasuries are where they are right now, specifically short-term treasury notes at like the 2-year note at about 4.2% roughly, your deals need to be really freaking good for people to basically say, yeah, I'm going to take a risk actually and lose my money here versus basically making 4.2% for free. Guarantee, essentially, right? Kind of nuts to think about. So that's kind of a challenging point in the market cycle that that we have to provide and solve for. There is when the treasury markets do go up, debt goes higher, investors' options start changing.
Yeah, I really do take issue with this argument. It's a pervasive argument. A lot of smart people use this argument, right? They go, think about a billionaire, right? And they have $100 million laying around, and they just have it in a money market, and they're making $5 million a year just on a 5% money market, CD, whatever it is, right? Just treasuries. And they'll say, well, why would I invest in your deal? Your deal is, I have to invest in real estate. That's risky. It takes time.
There's debt. I could technically lose money.
Yeah, there's debt. I could lose money. And all you're offering me is, let's say, a 6% cash-on-cash return. That's only 1% better than what I'm getting risk-free right now. Why would I do that? So a couple reasons why I think that's a fallacious argument. Number one is you're talking about just the cash flow portion of the investment and not the upside potential associated with equity appreciation.
But now's a bad time to invest in the market, one might say.
Sure, one could say that, but if you just look at the historical returns associated with real estate, general appreciation, et cetera, especially if you're buying in a growth market, the argument could go on. Secondly, you have to look at post-tax returns, not pre-tax returns, right? because on a post-tax basis, if you're earning 5% in a money market, that's interest income, and you're going to have to pay income.
50% if depending on where you're at.
Yeah, depending on where you're at, you're talking about 30, 40% you're going to be paying on those gains. So your 5% in a hurry is going to be a 3% post-tax return. Whereas if you invest wisely in real estate equity, you can do that on a infinity tax deferred basis and effectively achieve a post-tax return that is commensurate with your pre-tax return. So let's say the deal is pitched at a 15% IRR, and you say, you know what, I don't really believe in that because now's not a good time to invest and the sponsor's too aggressive, so I'm going to say it's 10%. But I believe in real estate equity's ability to be a tax shield for me, and I can get these gains tax deferred through depreciation, through 1031 exchanges, and I can effectively achieve a 10% post-tax return. Well, that 10% looks a whole lot better than that 3% post-tax return, obviously, right? But the cash flow is not going to sound too dissimilar on a pre-tax basis. So I take issue with the argument. I don't think that real estate equity should be benchmarked against cash rates.
Fair enough. So let's get on to another topic. Speaking of debt, speaking of this, that, there's a multifamily myth, which is, rate caps. So let's go through that. I think you had a lot to speak on this topic, so let's get into it.
Oh man, where do we begin? So to set the stage, for those that don't know, an interest rate cap is a hedging instrument that often lenders require borrowers to purchase when they're borrowing floating rate debt. And it makes sense because as a lender, you want to make sure that your borrower is in the best position possible to pay your loan. And so if you're going to offer someone a floating rate loan, you want to be protected in the case that rates go up a lot. You want to make sure your borrower can still pay that higher rate, right? So a lender will say, you know what, for the first 3 years of the loan, or often we're talking about bridge loans, which only have a 3-year term anyway, and this is great for a lender, right? If I'm lending floating rate debt for 3 years, and I say, and you have to buy an interest rate cap for 3 years and have a 3-year protection on your floating rate debt, that makes me feel really good as a lender. And the way that an interest rate cap works is the borrower goes to a third party, another bank or a hedging provider, and says, okay, I need to put a cap on my floating rate risk. So rates are, let's say, well, today they're super high, but let's say they're lower. Like, let's say SOFR is 2% today, and I only want to withstand a 2% rise in SOFR. So I want to buy a ceiling. I want to buy a cap at 4% SOFR. So that spread there, if SOFR rises and actually exceeds 4%, then the hedge provider is going to start chipping in and paying you the delta. So you'll still pay the full mortgage interest to the lender, but then you'll start to receive a offsetting payment from your hedge provider. So it's kind of a three-way cycle between the hedge provider, the borrower, and the lender, and it all works great, right? And it establishes a maximum threshold on your floating rate debt. The problem with all this is these hedges aren't free. When you go to that hedge provider and you say, hey, I'd like a ceiling on my interest rate, they go, great, now give me $2 million, right? Or whatever it's obviously all based on percentages, right? And the cost of a cap is based on two things. Well, a lot of things. But it's based on the strike rate, so where do you want your ceiling to be relative to where rates are today. It's also based on what the market believes rates are going to be in the future, right? Like today we have high rates. So if you wanted to buy an interest rate cap at today's SOFR, that's going to be quite cheap because actually the market consensus is that SOFR comes down. So the hedge provider is unlikely to actually ever pay you any money. So what could happen is you're basically buying a cap, you're buying that protection at today's rate, and it's very likely that the hedge provider actually never pays you a dollar. You just paid them money for the protection. It's like insurance that you don't use, right? And so, but if you buy an in-the-money cap, so you buy a strike rate that is less than where rates are today, it'll start immediately paying you out. But of course, it'll cost more money. So the cost of the cap is going to be based on the duration of the cap, right? Obviously, a 2-year cap is going to cost more than a 1-year cap. And then, of course, the strike. And then the big factor here also is volatility, the unknown, right? Because a hedge provider wants to cover themselves in the case of an unknown, right? They need to protect themselves in case, what if rates actually do go up even though the market thinks it's going to go down, right? So you're always paying for that implied volatility there. So that sets the stage. That's just interest rate caps 101. Now we're going to go to a little bit to 201, and we're going to talk about what's happening in today's environment, because today we have a high short rate environment.
Would you even want to buy a rate cap if you were to, use a debt instrument that would, I guess need one? Maybe your investors would probably make you get one because they wouldn't feel comfortable with it. But would you even think it'd be the prudent choice if you think that rates are going to go down? Because you're kind of arguably just burning money, correct?
Yeah, I mean, the market thinks rates are going to go down. If the borrower thinks rates are going to go down, then there's not really a point in buying the cap at today's rates. Now, what a lot of people aren't doing that. A lot of people are buying interest rate caps today at called in the money. So they're buying a cap that will begin paying out month one. And so let's say SOFR today is 5. A lot of people are buying caps at 3 or 2%. And so if they're buying a 2% cap and rates are 5, that's a 3% delta. They're basically going to, if they buy a 12-month cap, they're basically going to prepay 3% of their loan's interest up front. And then it's going to create an artificial fixed rate loan for them, because for the duration of the cap. So if you do buy the strike at 2, you've now artificially lowered your rate ongoing on a monthly basis to 2% plus your spread. Let's say the spread is, on a bridge loan, spreads are 350. So your rate's now artificially brought down to 5.5%, but it costs you like 4% of the loan amount up front. So if you're borrowing, $10 million, you had to pay 400 grand for that cap. So it's a lot of money up front. And what that's going to do is it's going to trade, stay with me on this, it's going to trade total returns in exchange for enhanced cash flows artificially, right?
It's kind of like basically doing a 2-1 or 1-0 buy down for anyone's buying a house, anything of that nature, right? You're basically teasing it down, correct?
Yeah, you're not like fundamentally creating more cash flow, but you're artificially creating more. You're financially engineering more cash flow because you essentially just prepaid interest up front, and now you get to enjoy higher cash flow ongoing because you have an artificially lower rate. And this is great.
What product do you need to have this kind of instrument go to place for debt?
You need to borrow floating rate debt and then purchase a in the money interest rate cap. So
what about bridge debt, though? Do you need that as well for bridge debt?
No, it just needs to be floating rate debt.
Okay.
So it could be a long-term floater, it could be a short-term floater.
So what's the difference between, I guess, that, because rate caps are expensive, and then also let's go to bridge when you kind of do a synthetic bridge, right? Because they're kind of similar in some respects. Is that correct, or am I mistaken?
Well, the vast majority of bridge loans are floating rate. So all this stuff mostly applies to bridge loans because a lot of people, especially today, are not borrowing long-term debt that's floating. And there's a few reasons for that, but
recency bias being the largest.
Recency bias is a big one. The way that those loans size very unfavorably, because you're sizing based on today's rate rather than the fixed rate equivalent. So because we have an inverted yield curve, when you talk about SOFR versus the long end of the curve, it's inverted. So you can actually get, on today's basis, you can get cheaper fixed rate debt than you can floating rate debt. Now, over time, of course, the floating rate loan should come down, so maybe it averages to costing about the same as the fixed rate. Theoretically speaking, that's how finance should work. But today, you're going to have a higher interest rate, so the lender is going to penalize you for today's higher interest rate on the floating rate basis and not give you as high of LTV, going all the way back to our discussion about debt service coverage ratios, right? You're going to be penalized because you have a high in place rate today, which is then factored into DSCR. So I just want to hit that point again because I think it's not easy for people to understand. Not all cash flow is the same. If I'm talking about financially engineered cash flows by way of purchasing a deep in the money interest rate cap, I'm going to, yes, have higher cash flows, but it comes at a cost. And that cost is higher upfront costs. And what do higher upfront costs do to my deal? It increases my basis, right? So if I'm buying the deal for $15 million and I'm financing the deal with $10 million of debt and I had to pay 400 grand for that rate cap, but it's not gonna be 400 grand because I need not just a 1-year rate cap, I need a 3-year rate cap because that's how long my deal is gonna be at minimum. So now I take 400 grand and I times it by 3, $1.2 million of cost up front. if I'm using $5 million of equity to buy this deal, I just added 20% of my equity just so I could manufacture these higher cash flows. What that's going to do is it's going to make it harder to make a profit on the sale, because now I need to sell the property for an extra $1 million just to be able to make the same profit as if I were to have not used the interest rate cap structure. So I think this stuff is very difficult for most investors to actually dig into a deal and figure out what's going on and understand, are these cash flows legit? How do I compare apples to oranges across different deals? Because you might see deal X and the sponsor saying, hey, this deal is a 7% cash flow. And then another deal is, hey, this deal is a 5% cash flow. And what, that doesn't tell you the full picture, because the 7% could be based on doing all the CapEx up front, which is another financial engineering thing we can discuss, as well as buying a deep in the money interest rate cap to have an artificially low interest rate to manufacture higher cash flow. Meanwhile, the cash flow at the 5% deal Y, for example, could be no interest rate cap, and you could be doing your CapEx out of cash flow, which again is going to reduce your cash flow available to distribute out to the investors. So there's just so many ways to look at cash flow, manipulate cash flow. There's even more ways to manipulate IRR, right? Because we all know that we can push our finger on the exit cap button and all of a sudden our IRR looks better.
That's on the front end, of course, not obviously during the deal process or on the exit, just so we're clear here.
Yes. Yeah. So yeah, I'm kind of starting to branch out into a lot of different topics, but yeah, I think the big takeaway is definitely on interest rate caps and the way that you're basically prepaying interest, which builds up your basis, which makes it harder to make a profit on the back end, but makes your cash flow look better on the short end.
Makes sense. We could go on forever today, but we should probably end it here. Any final thoughts?
No, I think those are some good bars.
Yeah, we've got a lot left to podcast about, so we'll be having several in-person podcasts for the people. Always better in person. Thank you for your time today. You crushed it. I'm still marinating and thinking about a lot of the concepts talked today, and I'm sure they're going to be circulating with me for a bit, and hopefully the audience here. So thank you so much for listening, and we'll see you soon with a new president.